Good day. In 2021, the South African economy performed better than most forecasters expected on the back of a more supportive operating environment, both for Nedbank and our clients. Off the low base in 2020, the economy rebounded to grow by 4.9%, due mainly to higher commodity prices, lower levels of lockdown restrictions, and some positive developments on key reforms in South Africa. Retail credit demand benefited from low interest rates, as well as the easing of lockdown levels, while corporate credit demand remained muted, and excess cash, particularly in the commodity sector, was used largely to repay debt. We are pleased, but not surprised, that after a volatile and difficult year for the South African banking sector in 2020, in 2021, South African banks continued to demonstrate strong levels of resilience, remaining well capitalized, liquid, and profitable, and as a result, are able to play a strong role in supporting clients and the economy. We expect conditions in the South African banking industry to continue to improve into 2022, as growth in loans to households and companies is forecast to increase further, supported by the anticipated lower levels of COVID-19 restrictions, resulting in an ongoing normalization in economic activity and increased levels of investment activity, particularly in the energy and telecom sectors. The downstream impacts of higher commodity prices should also support economic growth. Recent developments in Ukraine and Russia pose downside risks to global growth, and we join many around the globe in denouncing the unnecessary violence and loss of life and in calling for a speedy resolution to the conflict. We delivered a strong financial performance in 2021, reflecting a faster than expected rebound off a low 2020 base. Full-year headline earnings increased by 115% to 11.7 billion rand, a significant improvement on the decline of 57% in 2020, but still 7% below 2019 levels, and basic earnings were up 224%. Headline earnings for the year was driven by a significantly lower impairment charge, a higher net interest margin, a recovery in non-interest revenue growth, disciplined expense management, and a stronger financial performance from our associate investment in ETI. Key drivers of shareholder value continued on an upward trajectory, with our net asset value per share increasing by 11% and the group's return on equity improving to 12.5% compared to the 6.2% reported in 2020. And we have resumed dividend payments at 2.02 times cover for the full year, with the final dividend being declared at 1.75 times cover, which was at the bottom end of our cover range, signaling confidence in our strong capital and liquidity positions to support ongoing client growth as well as growing dividend payments. In addition to the strong growth in earnings, I think it's important to shine a spotlight on our key balance sheet metrics that have now strengthened to above pre-COVID-19 crisis levels as we concluded the resilience phase of our post-COVID-19 strategy pivot. Capital and liquidity ratios increased, as reflected in our Tier 1 capital of 14.3% compared to 12.1% in December 2020, Common Equity Tier 1 of 12.8% compared to 10.9% in December 2020, a liquidity coverage ratio of 128% compared to 126% in 2020, and a net stable funding ratio of 116% compared to 113% in 2020. As Chief Executive, I'm hugely grateful for the hard work of all 27,000 Nedbankers as we made excellent strategic and operational progress during a year when so many of our employees were still working from home as a result of COVID-19 rules. Central to our strategy has been the complete refresh of the Nedbank IT stack to build a modern, agile, modular, and digital IT stack that is a vital underpinning of future competitiveness. Investors will know we refer to this as the managed evolution. And in 2021, we reached 85% completion. These large IT programs in banks are difficult to execute and deliver on time, on scope, and on budget. And in 2021, we had an external benchmarking done on our managed evolution by 2 global consulting firms with very pleasing outcomes. This has given us confidence in our ability to compete and win in digital financial services, and has enabled us to confirm that the IT software asset on our balance sheet has peaked at around 9 billion rand, and the completion risk in respect of the balance of the managed evolution has decreased materially. The revenue benefits of managed evolution are evident in most of our digital metrics showing double-digit growth, and the cost and productivity benefits are evident in TOM2 benefits of 967 million rand, being realized ahead of schedule as we progress towards our target of 2.5 billion rand by the end of 2023. This is in addition to the TOM1 benefits of 2 billion rand already achieved in 2020, as we shifted our IT build methodology from waterfall to agile and rolled out our digital fast lane innovation capability. Building on the managed evolution foundations, our Avo super app platform play has made excellent progress in scaling up the number of registered clients and surpassed the 1 million user mark at the end of February 2022, which is well ahead of the target we had set for the end of 2022. The Eclipse journey for onboarding new clients, individuals, is now materially complete, and 6 retail products and over 170 services have been digitized. In 2021, we completed the build of our juristic onboarding through the Nedbank Business Hub and in our wholesale business, and our client rollout is well underway with good feedback. Pleasingly, during the year, both our client satisfaction and net promoter score performance continued on an upward trajectory. In the independent 2021 Consulta survey, Nedbank achieved the number 2 ranking among South African banks on client satisfaction metrics, with our net promoter score increasing further to 47. Progress on our strategic portfolio tilt 2.0 was evident in market share gains in key product areas and main banked client gains, as well as improved levels of cross-sell. Notably, Nedbank recorded the largest retail main banked market share gain among large South African banks in the Consulta survey, while our corporate investment bank gained 35 new primary clients. Our market share growth in retail transactional deposit accounts was disappointing and remains a key focus for the management team. Looking forward, I strongly believe that our strategy remains appropriate. In particular, our focus on technology as we finalize the last pieces of our managed evolution journey, which is central to our future competitiveness in financial services. Client satisfaction metrics remain top of mind as we aim to be number 1 amongst South African banks, and I remain confident that the unlocking of benefits from TOM 2.0 should continue to accelerate. We will actively leverage our balance sheet to grow clients and transactional income, and I'm optimistic that through our strategic portfolio tilt 2.0, market share in retail transactional deposits should also improve, and we have seen some more positive trends in the 4th quarter of 2021. In a more digital world, we are also excited about the accelerated digital transformation of banks, spurred on by COVID-19 as client activity increasingly shifts from physical products, services, and outlets to digital products, services, and channels. At Nedbank, as client behavior changes, we will continue to optimize our physical channels, leveraging the increased shift to digital payments. Since 2019, there has been a surge in the use of Nedbank banking apps, a 96% increase in active app users, 159% increase in app volumes, and 163% increase in app values transacted. In response to this, we continue to optimize the shape of our physical infrastructure through Target Operating Model 2.0, and branch floor space has decreased by around 65,000 square meters from 2014 levels, and we see further improvements from here. As client digital adoption increases, employee numbers are also declining, largely through natural attrition. Through our strategy of consolidating, standardizing, and optimizing our own buildings to support new ways of working, our number of campus or office sites has decreased from 31 to 24 over the past few years, with a longer-term target of 19. In the next few years, we will continue to optimize the portfolio by bedding down more dynamic ways of work, as well as leveraging successful work-from-home experiences as a result of COVID-19, while enabling further value creation and cost reduction opportunities as we strive to meet our 2023 cost-to-income target ratio of 54%. Living our purpose of using our financial expertise to do good and creating positive impacts in societies in which we operate are a core part of our Nedbank DNA and a key strategic imperative for unlocking value for all our stakeholders. This is demonstrated through our ongoing delivery against the United Nations Sustainable Development Goals and a continued focus on leading in ESG matters. With the increasing focus on these issues, the progress we have been made continues to be reflected in our scores across all ESG ratings being towards the top end of our local and international peer group. The release of our market-leading energy policy and inaugural TCFD report was a key highlight for me in 2021, as was the successful launch of Africa's first Green 81 instrument. At the end of 2021, our renewable energy financing portfolio linked to the Renewable Energy Independent Power Producer Procurement Program was 29 billion rand. And we remain well positioned to support government's renewable energy program with an initial 50 billion rand board limit in place to accommodate future client lending support. I eagerly look forward to our participation in the upcoming round 6 of the program, and am encouraged by the strong embedded energy generation pipeline we have in place following client responses to the increase to 100 megawatts of self-generation capacity. A stable and efficient supply of electricity is vital to higher levels of economic growth and job creation in South Africa, and we aim to be a market leader in this area. Looking ahead, we see a big opportunity to participate and lead in new financing opportunities aligned with the United Nations SDGs, while leveraging our sustainable financing solution expertise, arranging innovative green funding instruments, and channeling the funding towards the further development of the green economy. Our focus on driving the transformation agenda continues to be a priority, and this is evident in our increasingly diverse and inclusive workforce profile. Black representation of our total workforce now exceeds 79%, of which 50% is represented by Black females. The COVID-19 pandemic and the July civil unrest have once again laid bare South Africa's socio-economic challenges, specifically unacceptably high levels of unemployment, poverty, and inequality. More inclusive economic growth is needed urgently to support job growth and address these challenges. Much work needs to be done if we are going to realize these higher levels of inclusive economic growth in our lifetime. We need urgent implementation of structural reforms. I firmly believe that genuine structural reform in South Africa remains too slow. And while there are some green shoots emerging that we welcome, Reform like an increase to 100 megawatts in self-generation capacity and the recent spectrum auctions should have happened many years ago. When this is combined with the lack of reliable electricity supply from Eskom, it means that after the bounce back in GDP in 2021, GDP growth in the next few years is likely to remain below 2%. Investors look for higher levels of growth to balance the higher levels of risk inherent in emerging markets. And unless we have these higher levels of growth, unfortunately, we only have the higher levels of inherent risk, and much needed investment capital will shift elsewhere. As a purpose-led organization, we continue to play our role in driving the socio-economic development of our country, partnering with government, labor, and civil society. In 2021, we reactivated our commitment to the YES initiative, through which Corporate South Africa aims to provide internship opportunities for more than 1 million South Africans. To date, we have placed more than 5,000 previously unemployed youth internally and through sponsored placements, and we continue to encourage other South African corporates to follow our example. Looking ahead, we expect higher levels of revenue growth and continue to focus on costs to support a solid financial performance for the full year in 2022. We should continue on our positive trajectory, underpinned by our ongoing strategic and operational delivery, as we make progress towards the medium-term COVID-19 recovery targets that we have set for the end of 2023. We remain on track to meet these targets and, pleasingly, now expect to meet the diluted headline earnings per share target of greater than the 2019 level of 25.65 rand per share in 2022, a year ahead of our previous expectation. We continue to focus on achieving an ROE greater than our 2019 ROE level of 15%, reducing our cost-to-income ratio to below 54%, and ranking number 1 on Net Promoter Score among South African banks, all by the end of 2023. And these targets remain stretch targets. In the longer term, we aim to increase our ROE to above 18%, or cost of equity plus 3 to 4%, and our cost-to-income ratio to below 50%. The macroeconomic environment is expected to remain challenging over the next few years. And while interest rate increases are good for us from an endowment perspective, as we earn approximately 1.6 billion rand pre-tax for each 1% uplift in rates over 12 months, faster interest rate increases may start to impact client repayments and therefore bad debts. The situation in Ukraine and Russia is worrying, and we strongly oppose the violence and loss of lives we are seeing. Economically, this is likely to have a negative impact on global economic growth, inflation, and interest rates. Nedbank has no direct exposure to Ukraine and Russia, and any indirect exposures are immaterial. The impact on South Africa is likely to be indirect and less negative than on many other emerging markets, as higher oil and food prices will likely lead to higher inflation, breaching the top end of the SARB band in the first half of 2022, but this will partially be offset by the benefits from higher gold and other metal prices, with these commodities accounting for 50% of South Africa's exports. Our people are at the center of our business. The health and safety of our employees remain a priority for us as we learn to live with the pandemic, which has and will continue to impact how we work. As our hybrid work model approach gains momentum, we are working on bringing more employees back into the office in a COVID-19 safe manner, as this is important for teamwork and our culture, as well as innovation and growth. Our optimal workforce distribution mix is expected to settle at around 60% at Nedbank premises and 40% either following a hybrid model or permanently working from home. As we look to 2022 and beyond, we will continue to focus on our human capital strategy as a key enabler on delivering on the group strategy and the 2023 medium-term targets, while nurturing a culture of diversity, equity, and inclusion in the workplace. Executive succession planning remains top of mind for me ahead of the retirements in 2023 of our Chief Risk Officer, Trevor Adams, and our Chief Information Officer, Fred Swanepoel. Through our robust executive succession planning process, suitable successors will be appointed ahead of time to enable seamless transitions. The past 2 years have been unprecedented and extraordinarily difficult for our clients and employees. Throughout the COVID-19 crisis, our dedicated 27,000 Nedbank employees have remained resilient and inspiring. We thank you for continuing to diligently support our clients and the economies in which we operate. Together, we have emerged stronger and delivered on our purpose of using our financial expertise to do good. We extend our heartfelt condolences to the families, friends, and communities of employees and clients who have lost their loved ones during this time. Thank you to the chairperson, the board, and my executive team for their continued support as we have navigated uncharted waters, with this culminating in the stronger than expected financial rebound and the successful closing out of the resilience phase of our strategic response to the pandemic in 2021. The passing of our former chairperson, Vasi Naidu, was felt by all at Nedbank who knew him. Vasi made an indelible mark on Nedbank, and his wealth of experience and wisdom will be sorely missed. I would also like to thank our Chief Compliance Officer, Anna Isaac, who will be leaving Nedbank at the end of April 2022 to take on a new compliance job in the UAE, for making a significant contribution to Nedbank during her tenure. We have concluded our interview and succession process, and we will announce Anna's replacement as soon as we have obtained regulatory approval. Thank you.